Tesla shares in focus as the EV maker slightly missed estimates for second quarter deliveries. Let's talk more about this with Deutsche Bank lead auto and auto technology analyst Emmanuel Rosner. Emmanuel, always great to get some time with you. So you are out this morning, new note, have a price target of $1,125. Why that optimism after this delivery miss?
Hey, good morning. Thanks for having me here. So first of all, the deliveries themselves were basically in line with analyst expectations, 255,000 units. That's basically maybe 1,000 or 2,000 units shy of what analysts were looking for, and that was pretty much predictable because they were shut down. Their Shanghai factory was shut down for most of the quarter because of COVID lockdown. So there was definitely a lot of units of production that didn't happen, a lot of units of deliveries that couldn't happen. I think what's important for this stock is basically to look forward. And as part of the release, Tesla commented that June was the highest months of production ever in the company history, which means that they're really lapping some of these, supply chain and lockdown issues, and that they're really ramping up. And that makes us very optimistic for the second half of the year, in terms of what production could look like. We still think they're on track for 1.4 million units for the full year, which is up 50%. And they've also done an incredible job, pricing up for some of the raw materials pressure. And so we think the margins could actually, look good going forward. So Q2, definitely a challenge, but a predictable one. And I think it looks good going forward.
Okay, and so you kind of started to answer my question there on the unit front, because even as we've started to see them raise prices, to what extent will that impact some of the demand that they're seeing?
That really is one of the most important questions for Tesla and for the industry. Obviously, raw materials pressure has been, relentless. The cost of building EVs has gone up, and Tesla has been incredibly proactive at, raising prices. I think they've done so at least 10 times in the U.S. just last year, and then multiple times again this year. Now, from what we're able to see, the wait times to get a car are not getting shorter. You still have to wait several months, in some cases well into 2023, to get your vehicles in most geographies where Tesla operates. So there is no sense that so far it's hurting the order book. There's no question sort of like that at some point. This is obviously a very legitimate question, just no evidence of it right now.
Emmanuel, have you stress tested your models in trying to figure out what this stock and what Tesla's profits look like in a recession?
Yeah, so I think one thing that's I think particularly important to to note is you essentially have the world moving towards electric vehicles. So the adoption of electric vehicles is really rising incredibly fast. The ability of the industry to supply is not happening as fast as the demand is growing. This is why the few EVs that are available or even coming to the market have very long order books, sometimes multi-100,000 units, and certainly many years of wait time. I think, but what's essentially going to happen is this is going to be about success in EVs is going to be about the ability to supply. And Tesla has demonstrated both last year when the whole industry was losing a lot of volume because of semis, and this year through some of the shutdowns, that they're the ones that are actually able to keep producing. So I think what essentially is going to happen is Tesla will be the ones able to supply the vehicles, even if overall demand were to come down somehow. This would actually shrink the order book. They still have, many months of forward-looking orders there. So we're really not too worried about the volume trajectory for Tesla, even if you go into what would be considered sort of like a mild recession. I think that they would capture the demand from those that could still afford it, in the context of essentially the whole world moving to EVs and just not that many credible alternatives here.
And let me just follow up on that, Emmanuel. So is Tesla still growing sales inside of a recession? I believe the Deutsche Bank team is looking for a mild recession in the first half of next year. In that environment, is Tesla still growing sales? And is that coming more from price or units?
Yeah. So they are. Our view, both for the auto industry and then Tesla specifically, is that you're going to continue to see, auto sales grow. In the case of the broader industry, it is because we're starting from recession level volumes. The SAAR right now is at 13 million for the month of June. This is recession level SAAR. It's been supply constrained. As supply bottlenecks get alleviated, you're going to see essentially more more production and therefore more sales. And so we see pretty good visibility for auto sales going up easily for the next 18 to 24 months, almost regardless of the economic backdrop. In the case of Tesla, it will come really from primarily from units. Essentially, they're still at the beginning of ramping up factories in two regions, in Texas as well as in Berlin. There is tremendous demand for EVs in Europe, which has been so far being served by, the China factory. Now there will be, there is, ramping up a factory locally there. This is a whole new, ability to serve this market at a better economics. The Chinese market itself is now rebounding incredibly fast after the COVID, lockdowns. So I think that the whole Shanghai factory will be able to serve it, and the company is in the process of adding more capacity over there. So essentially, it will be driven by units. As you move into 2023, you're also going to see new models. Potentially the Cybertruck. We'll look for an update on this. But this is something that has many hundreds of thousands of units of reservations. People have been waiting for many years. This is all incremental, versus the base demand. So my answer would be yes. We expect, volumes to keep growing both for the industry as well as for Tesla, even in a recession in 2023.
And so much of that growth, to your point around the Cybertruck, is really around them getting that category, that model that has done so well for other auto manufacturers over decades, getting that approach correctly. And I mean, it's estimated at this point that they might even have well over 1 million reservations. And so, how quickly are they going to be able to get some of that backlog solved for? Because it sounds like, based on what we've heard from the company, I mean, this could be a situation where they're not able to fulfill those obligations until 2026, 2027 even.
Yeah, that's a great question. So as of now, starter production is, latest updates from Tesla is sometime in 2023, so call it sort of middle of the year. Unclear exactly how much capacity there will be, dedicating specifically, to that product line. But assuming that they start with maybe 200 or 300,000 units, a year, which would be sort of like a portion of the Texas factory, yes, it would certainly take a number of years to just meet the existing backlog of orders. Now, if obviously the orders stick around and they see sort of like good pricing and good reception in the market, they could certainly, ramp up, capacity further, just like they're doing currently in China, potentially ramping this up to 500,000 units or so a year, and therefore being able to address the backlog. But I have no doubt that if someone were to place an order for a Cybertruck today, it would take several years until they could actually get one.
All right, moving on and sticking with the latest in D.C., our next guest says the Supreme Court's decision to strike down the Biden administration's regulations on emission, this potentially has enormous implication for other regulatory agencies. And joining us to discuss this is Greg Valliere, AFG Investments Chief U.S. Policy Strategist. And Greg, always great to see you here. You heard what Kevin was talking about, but you have some additional insights here into this latest SCOTUS decision. And I have to ask, have we reached peak bureaucracy, and realistically, how much could we hope to roll back?
I think quite a bit, and great to see you again. This was an enormously important decision, eclipsed obviously by the abortion ruling. But a lot of people who follow regulatory policy consider this to be a bombshell. Basically, as you know, what the Supreme Court said was that on environmental rules, you could not just have the EPA make this decision. It had to be done with Congress. And if you apply that standard to other issues, you could be talking about the Securities and Exchange Commission with Gary Gensler. You could be talking about the Federal Trade Commission. If they try to regulate and people who don't like the regulations sue, and it goes all the way to the Supreme Court could uphold the rulings in favor of business. A huge decision.
Well, and let me ask you, we just saw a huge fallout from the decision of from the overturn of Roe v. Wade. We have a number of state laws that have taken over in the wake of this. I'm just wondering if we were to have another big decision at the SCOTUS level regarding regulation, regarding the build out of the bureaucratic state, is there a potential fallout with unknown ramifications that we could see that's similar?
I suppose if you tell the SEC they can't go after corporate executives on transparency unless they work with Congress, I guess my initial take would be they better work with Congress. But yes, I suppose there could be real confusion in the business world if we got to that point.
And let me shift gears here and go back to something the previous guest, Kevin, was talking about, and that's the potential rollback of Chinese tariffs. And I was surprised. I had to think about it. Yes, it's been 4 years, almost seems like a different age because it was so different, but they're still here. And what could this possibly bring toward economic relief?
I'd like to say it's a big deal, but in terms of the inflation impact, it's a few tenths of 1%. When we've got an inflation rate of 8%, that's not a lot. But at the same time, I'm encouraged that maybe the U.S. and China are getting a little closer after this acrimony we've had for several years. We'll have to wait and see. But I think that this will be one of these split the difference decisions where the president will have to do something that organized labor likes, but he's going to have to do something that Janet Yellen likes. So you'll get something, but I don't think it's going to be a game changer.
Well, and you're writing about another controversy with respect to China. This would be the stalled U.S. Innovation and Competition Act. This includes $52 billion for U.S. semiconductor manufacturers to compete with China, but it's being locked up in the Senate, I believe, right now.
Yeah, I had thought, like most people, that this bill would make it. Chuck Schumer is the big proponent. It would give an enormous amount of money to chip manufacturers here in the U.S. But suddenly, last week, Mitch McConnell said no. He would not go along with this because the Democrats are trying to jam through the remnants of Build Back Better, which includes prescription drug price controls. McConnell says no. And if he says no, we might not even get that bill.
Well, and I want to ask you about the price of crude oil and the potential here for any actions on the Biden administration, because breaking news, WTI just slipped below $100 per barrel for the first time in quite a while that I'm seeing. Is there anything that Biden can do heading into the midterm elections to really lower the price of oil, or is he simply out of bullets?
He's pretty much out of bullets. I thought his call for a tax holiday on gasoline was a stunt, and it's never going to make it through Congress. That's pretty clear. He'll go to Saudi Arabia in a couple of weeks. That might have some impact. But no, what's going to bring the prices down of all these commodities is an economic slowdown, and that's exactly what we're seeing in the markets right now.
Well, and this is all potentially a tailwind for the Republicans. And now you have President Trump, perhaps, well, maybe more than perhaps, running for president in 2024. A lot of Republicans up in arms here, as you're writing about as well. How are you seeing this shake out?
Well, if Trump announces in August, and that's the rumor right now, that would infuriate Republicans who thought they had a clear path to taking at least the House on November 8th, maybe even the Senate. But if you have Donald Trump stomping on their message, making the election all about Donald Trump, that's going to really complicate things for the Republicans. They don't want to relitigate the last election. The Republicans want to move forward, and Trump is going to complicate matters.
And we got to leave it there. Always appreciate you stopping by.
Okay.
Greg Valliere of AGF Investments.
Rising inventories have been rocking the retail space as companies continue to overestimate consumer spending power. But the excess goods may provide a new opportunity for companies like Overstock. Joining us now to discuss is Overstock CEO Jonathan Johnson. Jonathan, good to see you as always here. So when you survey the landscape and you start to see these inventories pile up in many retailers, does it scream like a recessionary environment to you?
Boy, there's no question it's a very tough retail environment right now. We actually think that's great for Overstock's business model. We're asset light. We don't own inventory, so we're not sitting on a bunch of inventory. It's yellowing. We are able to sell our inventory that we list on our site because of our smart value proposition. Customers are cutting back on discretionary spending, but when they spend, they want a smart value. They want to stretch those dollars, get the most they can for what they're willing to spend. That's exactly what Overstock offers.
Jonathan, Guggenheim out with a note this morning voicing some concern about the growth rates in your business against this consumer spending slowdown. How have they been looking in recent weeks?
Well, look, there's no question that the consumers hit pause on this discretionary spending, particularly in the home goods market. But we think it's a pause. It's not a stop. The good news about the American consumer is she always comes back. I do think people are worried about gas prices and inflation. Again, we think our business model where we're offering, we have a good value proposition. We've got, product at any price point, always a deal. We think that when the consumer comes back, we'll be poised to be there. In the meantime, we remain focused on our mantra, sustainable, profitable market share growth. We think our balance sheet is strong. We're controlling the controllables so that we're profitable, doing our best to maintain and take market share in this tough environment.
And Jonathan, Brad here, what have you noticed in terms of the spend levels for those who are still buying on Overstock.com? Has that started to kind of trickle down or trickle lower, if you will, given some of the other high costs that they are navigating right now?
Yeah, that's an interesting question, Brad. In our first quarter print, we announced that we had the highest average order value that we've had in our history. People are still spending. They're just looking for value when they do so. So as we continue to complete our journey to be a home company, providing dream homes for all, our AOV will go up because we're moving out of kind of lower price point goods, and the consumers are willing to spend if the value is there.
Certainly, and it comes back to finding valuable products, but I wonder in this environment where retail companies and even a lot of the online e-commerce retail companies have had to look across their inventory and say, all right, we clearly have too much that we need to start to churn through now. Have you had to hit pause on some of the partnerships where you typically would be taking in that inventory from, or do you just continue to move forward, holding on to that for a time when the consumer does come back?
Well, we're always working to increase the breadth and depth of our SKUs, and we're having success doing that. You do mention one kind of difficulty for us, and that's when some of our competitors who own inventory choose to liquidate it and lose money. That makes the competition more stiff, and sometimes we have to remove product from our site for a time while others are liquidating. But we've been able to remain competitive and are working to maintain profitability and working to grow market share.
Jonathan, I've started to travel the malls a little bit more recently looking for a good deal, and I've been surprised by some of the discounting a lot of big retailers are offering right now. Has discounting crossed that line into irrational zone?
No, I think it's coming back to kind of a more normal place. You have to remember, a year ago, we were in a very different place where supply was underpacing demand. Today, it's probably the opposite. But I think that there are retailers that are discounting big. But I think most of us are looking at this the long run. Most of our partners have a long historic perspective, know that if they work to maintain price, that they'll sell through their inventory in due course. And so I don't think it's irrational yet, but there are certainly deals to be had, including deals to be had on Overstock.
John, I always love to get your sense on this crypto landscape here, considering the history that Overstock has had, one of the first retailers, the first retailer online to accept Bitcoin as a form of payment in this broader crypto winter that we're seeing right now. What most notably have you been keeping an eye on, and are you still holding at this point, even the small amount of Bitcoin that Overstock has in comparison to some of the other whales out there?
Yeah, we're still holding or hodling our Bitcoin. One thing I monitor is the amount of Bitcoin that's spent on Overstock each week. It's always been, less than 1%, a very small percent of our revenue. But during crypto winter, it's really dried up to where almost no one is spending Bitcoin or crypto to buy goods on Overstock. So I think people are, traders will trade in and out, but hodlers aren't spending like they were when Bitcoin was at a higher price.
If they stop spending in Bitcoin, is that something that Overstock thinks about sunsetting at that point?
No, it's an easy program for us to keep. We like it. It keeps our kind of toe in the water in this space. If it went to zero for a long period of time, sure, we might turn it off. But But I don't see that in the future. I think Bitcoin's taken a pause. And, as you know, more than cryptocurrency, we're really bullish on blockchain technology. We have a portfolio of companies. We have a venture capital firm managing. We think T0, Bit, GrainChain, these blockchain technology companies have a bright, bright future.
Welcome back. The housing market slowdown hasn't stopped techies from trying to figure out how to make the process of buying and selling a home a lot easier. In a new report, Citi looks at PropTech and how it's being developed to create a frictionless housing market. Roger Ashworth is the head of Citi's research, non-agency MBS strategy team and helped compile the report. Roger, good to see you here. Talk us through what is PropTech and what are some of the companies out there working on right now?
Hey, thanks for having me. I really appreciate this. This report is something we put out as part of a series. We're focusing on the housing market. It's called Home of the Future. Chapter 1 was looking at net carbon emissions, net zero carbon reduction in the housing market. Chapter 2, like you said, focused on fintech and companies looking to streamline various forms of the housing market and all sorts of transactions in and around it. Some of the interesting parts of the report that we talked about. Mortgage underwriting, which you don't really think about as a headline grabber, but there's a lot of process that happens in and around lending and mortgage lending, looking at borrowers' incomes, documentation, verification, and all sorts of other aspects of that whole process of enabling a borrower to get a loan to go buy a house. Other aspects of more headline grabbing, companies that are providing instant offers on homes. When you think about moving from one home to another, you have to sell one home. It's an emotional process. It's a lot of friction involved. And then you have to go buy another one. There are companies out there looking to streamline that process by providing an instant offer to your home. If you think about all the information that's happened over the information democratization that's kind of happened over the past decade or so, it's one of the spaces where kind of technology is finally getting to the point where there's enough information out there and able to help streamline the process in a whole bunch of different ways with property information and transaction data.
We're seeing the number of bids per home that's lower right now, and it's been decreasing with the mortgage rates rising in this period of time. How is that impacting where you're seeing the number of interested buyers and at what price they're still staying involved in the bidding process? That's true. If you look at like a lot of these publicly traded companies that do provide the instant offers on potential home sellers, certainly they're providing upwards of some publicly traded ones are advertising they're putting out 2 million offers, but their only hit rate is actually quite much lower than that. But like you said, existing home sales are starting to pull back. The affordability concern in and around the housing market is certainly something I keep track of as a research analyst, looking forward to projecting home prices because we're always worried about potential defaults and losses at some point in the future. But it's certainly something that we project out forward. And if you look at consensus estimates of existing home sales, we're talking in the neighborhood of 5 million homes per year. So certainly there's some market share to be grabbed and help streamline the whole process there.
What are some of the companies, Roger, doing this very well, and maybe some others not doing it well?
I don't have any disclosures. I have to apologize there to talk names, but we certainly follow along with research reports where we do talk names. But yeah, there's certainly businesses that have succeeded and some that have pulled back in the industry. It's certainly when you talk about the home buying transaction, these are large transaction amounts. It's probably, as a U.S. consumer, the largest financial transaction you ever undertake in your life. The potential for error and missing is certainly there in business decisions. But on a go-forward basis, we've already had a couple public companies report profitable quarters in Q1, and it seems like the potential growth path is certainly large. When you talk about the U.S. housing market, I think it's like a $37 trillion market. There's $26 trillion of equity. There's a lot of actually other investment business models where companies are willing to, instead of taking out a second mortgage, they'll simply purchase a piece of equity of your home for a share of that home price appreciation going forward. There's a lot of potential market share across the board and a lot of frictions that can be removed in the underwriting process and the real estate transaction process.
The housing market's become a little more volatile, to say the least, Roger. As you know, with rates going up, has that slowed the pace of innovation in an industry like this?
We haven't seen too much of it yet. The historically speaking, it's been a high friction process market. But again, these companies are all starting off from relatively small sizes. I think the innovations really have started happening since 2015. So the past like 5-6 years, the potential growth for market share in tech terms, total addressable market, it's quite significant. Even when we talk about things like mortgage underwriting, and we're talking about the cost of a mortgage to be originated is somewhere in the neighborhood of $8,000 to $10,000. If you can shave off $1,000 or $2,000 of costs and help share some of that with the consumer, and provide a better consumer experience, whether that be through apps and streamlined speed to underwrite and get people the money they need to buy a home. Because as we all know, there's limited supply of housing on the market for sale, historically low levels, and days on market, days to sell a home. Well, granted, like you said, we might see demand for housing pull back a little bit. Still, the days on market is relatively compressed, and anything you can do to streamline that process is certainly appreciated.
Roger, I understand that you also track some of the sales that are in the metaverse for real estate that is of a more digital nature here. But with the pullback that we've seen perhaps this crypto winter and even for a more protracted period of time, how has that impacted some of the people even willing to buy in a virtual reality for the meta me, if you will, to be able to live when I can't even buy a home in the real life right now?
Yeah, certainly that's been one of the parts of the report we discussed a lot and we debated actually putting into this at all. But it's something that, again, we take these GPS reports, so it stands for Global Perspectives and Solutions, and we get a chance to step back from our day-to-day investment recommendations and really just highlight some of the broad, big picture issues facing the U.S. economy, or the global economy for that matter, and the average consumer. We just highlight these trends that are happening. Try not to take too much of a stance on the metaverse, as you say. But yeah, there's other interesting aspects of various mortgage lenders looking to help people monetize that cryptocurrency. In other words, you can basically ring fence a piece of your crypto holdings and use it to go purchase a home as an effective down payment with a mortgage on the other side as well.
Let's bring in Kate Moore, BlackRock Global Allocation Head of Thematic Strategy. Kate, great to have you here with us today, particularly in a time like this where people are looking for a strategy and trying to best position their portfolio. What type of themes would you believe emerge where we're looking towards through the Fed activity and their policy decision making at the same time that they could potentially trigger a recession with that same policy activity and decision making?
Yeah, Brad, thanks so much. This is actually a really difficult time to be thinking very long term. We know, as you mentioned, that there are a tremendous number of cross currents right now in the market. It's not just, monetary policy, the reaction to inflation, the durability of inflation, but also kind of what's going on geopolitically. Certainly the Russia's invasion of the Ukraine, that persistent pressure is having on the energy market and on resources, combined with the stimulus, and as I was just mentioning, that was announced overnight in China. All of these sort of cross currents make it really difficult to discern a specific trend. And this is coming against the backdrop, of course, of the beginning of second quarter reporting season, where we expect companies are going to be offering, I won't call it tepid, but more cautious guidance over the future 4 quarters in terms of earnings, or at least expressing their uncertainty around the path for earnings. That said, there are a couple things, if we look a little bit further out, that we really want to focus on. One of them is, regardless of what happens to economic growth in the very near term, companies are going to continue to focus on digital transformation in their business. If you don't have the right tools and software and platform, you're just not going to be competitive with your peer group. And so we expect that investment to continue. The second, and this goes back to some of the commodity comments, is that especially over the medium term, the supply-demand balance really favors industrial metals and, in fact, many resources. So we want to use some opportunities, some of the weakness that we've seen in metals prices and energy, to kind of add for the medium term. And then the last theme is really around figuring out the right consumer business models that will succeed. More in the services side, we're already starting to see some of the rotation from goods back into services, the regular type of consumption we saw pre-pandemic. Although I do think it's a little too early to add to consumer names this summer.
Kate, I hear you on the earnings warnings. I very much agree with you. It could be a very challenging earnings season. What I'm trying to figure out is if companies come out in droves and warn, do you think that has been priced into the market here?
Yeah, Brian, I don't think that it's priced in at this point. And I don't even know that we're going to get companies warning. I think it's more likely that we'll come out and say, hey, we had an okay second quarter, or here are the tools we use to manage higher input costs. And this is what we're doing on the labor side. And this is how we're renegotiating with suppliers. And we'll get some constructive messages about the plans for the next couple quarters. But I think the greater risk is that we'll have companies expressing a huge amount of uncertainty, frankly, both into the top line and then potentially into the bottom line over future quarters. And that uncertainty will erode what is already pretty weak investor confidence. I think also if we get one company in a specific industry, we certainly saw this in the first quarter, by the way, one company in a specific industry say, we don't have a lot of visibility, we're concerned, we see risks, it gets extrapolated out to the rest of that industry, in some cases to the rest of the market. So there's some story stocks that could have an outsized influence on the overall risk appetite for equity.
How should investors be thinking about this earnings season? Is it worse if you see companies coming out, being transparent and saying, hey, we're going to guide lower? Or is it worse if you see companies just pull guidance because of that uncertainty?
Yeah, it's a good question, because guidance in general has been, or at least the number of companies that have been offering guidance has been declining for many quarters now. And the first quarter was definitely a weak period in terms of the number of companies offering guidance. That's just a reflection of the macro uncertainty and the policy uncertainty and the geopolitical uncertainty. I think a bigger fail, in my view, would be if companies came out with a tremendous amount of certainty and said, without question, we're going to see these sales. Without questions, we're going to be able to control these costs. This is the direction of travel. I think, investors are really looking for management teams to thread the needle, to express the uncertainty while also affirming what they do know about their business. In short, I think this is going to be a pretty noisy reporting season.
Okay, don't laugh at me on this question, or at least not on camera.
Right.
Is there a recession-proof investing theme that one should be looking to right now?
Okay, Brian, I'm trying not to laugh. I don't think.
Okay, fine. All right, fine.
I don't think there's specifically a recession proof. But one theme that I really liked as being less sensitive, frankly, in terms of spending cuts, has been around security software. This is something we've been talking about for a while. This is protection against cyber threats. No company, regardless of industry, can afford to have their systems hacked. It is like the number one business concern as we talk to chief technology officers, chief information officers. So I expect spend in that area to remain very resilient. Some of that is being reflected in our performance of some of the cybersecurity stocks so far this year. But I would say this is an area, as maybe not perfectly recession-proof, but is less subject to cutting in spend, because no business can afford this risk.
Okay, now I will let you go. You can go laugh at me and make fun of me to your colleagues. Kay Moore, BlackRock Global Allocation Head of Thematic Strategy. Always good to see you. We'll talk to you soon.
Thanks so much.
As the U.S. looks to bring chip manufacturing back to the U.S., a group of venture capitalists have teamed up to create what's called America's Frontier Fund. The fund is aimed at boosting the U.S.'s economic competitiveness and prosperity, and there's got some big name backers behind the fund. Joining us now to discuss is America's Frontier Fund co-founder and CEO Gilman Louie. Gilman, it's good to talk to you today. Anytime you get names like Eric Schmidt and Peter Thiel behind a fund, you're going to get a lot of attention here. But this does come at a time when you've got not just the White House, but also Congress really pushing to bring chip manufacturing back home. So what is the fund attempting to do that the government cannot?
One of the critical things for us to be successful in returning chip manufacturing, as well as many other deep technologies that are going to revolutionize the economy over the next decade, is to not just get alignment from the government and the research capacity of our great universities, but we got to get our capital markets involved, right? I mean, if you look at the U.S. as compared to a country like China, the Chinese are investing probably in the neighborhood of 10x what we're investing in these deep technology areas. And while their $2 trillion of commitment over the next 5 years is a lot of money, we have $45 trillion in capital markets. And if we can direct the capital markets to start investing in these critical infrastructures like microelectronics, not only do we shore up our supply chain challenges that we have but we also laid the foundation for the next generation of technology that we can create, $1 trillion or more dollars of economic wealth.
And so, you've also got some, big names within the national security space, like H.R. McMaster, who are backing this fund as well. And we've increasingly seen this issue framed as a national security issue. You've just highlighted how much money there is. I mean, is it really about just having the funds in place to accelerate the process, or is there more to the fund as you see it that could really go beyond what the government has already attempted to do?
Well, the government, particularly in our national security and national defense, is highly dependent on its microelectronics underpinning, right? Faster chips, higher performing chips makes your system smarter. Smarter is better, right? Particularly if we think about things like artificial intelligence, quantum computing, our advanced capabilities, all driven based on our access to chips. And I think the national security, as well as the Congress, realizes that 90% of our advanced manufacturing capabilities are within 110 miles of, China's missiles, or within 35 miles of a North Korean artillery battery. That's not a great place to be in if all your systems are dependent upon these critical chips. And we do not want to end up from a national security point of view, like Russia is facing in Ukraine, where they're basically desoldering chips from washing machines to keep their systems running. We need to stay in the forefront. We need to make sure our supply chains are secure. And this is a critical national security risk. And not to mention, our whole economic underpinning is based on a technology infrastructure that depends on these microelectronics.
And Gilman, given that inflation is top of mind here, arguably the number one political issue, number one election issue, and also the number one economic issue, where is the impetus for moving forward right now? I don't think anybody doubts that we need to beef up our domestic chip-making capacity and other things of that nature, but have we lost some of the momentum that we seemed to have a year ago?
Well, it's ironic that in technology innovation, that the best periods of technology innovation happens during economic downturns. And I think the reason for that is, the froth disappears, the easy monetization goes away, the technologist returns from a monetization framework into a discovery framework. So those great vintage funds that gave us things like, the current generation of processors that our entire infrastructure is built on, that gave us 5G and the entire 4G LTE backbone, that gave us the cloud and the internet, right? All of those funds that invested in those techs were done during those downturns. So while it is challenging from an economic point of view, I think it's going to really start a brand new renaissance as all of those technologists and scientists and investors return back to deep tech investing like we did back in the late 1990s.
And you just mentioned the creation of the internet. It's funny because your project kind of reminds me of DARPA. That would be the Defense Agency Research Projects Agency. Defense. Well, anyway, I messed up the name.
You got it right.
Okay.
You got it right.
Yeah, and they created the internet. And I'm just wondering, what happens with the technology, the companies that you may form? Is there some kind of exit strategy at the end, some kind of liquidity event, or is this just something to get the research and help? I guess maybe all companies, maybe perhaps in the U.S. here.
Look, the great news is DARPA is not stopping investing. If anything, the National Science Foundation and DARPA and IARPA and ARPA-E, all of these government-led initiatives are on the increase. We're spending more in R&D today than we've ever spent. But we have to cross the chasm between R&D and technology that scales to build great companies. And one of the things that we're committed to at AFF is the building of new ecosystems. Look, 5 cities benefited from all of the technology investments that we did in the last decade. There's San Francisco, it's San Jose, it's San Diego, it's Seattle, it's Boston. They account for 90% of the innovation jobs that got created in the last round of innovation. For us to experience continued growth across other great technology centers, we have to start investing in these critical infrastructure and these critical technologies across the country in these new places where technology is being created. It's in places like Atlanta, places like Georgia Tech and Arizona with ASU and CMU up in Pittsburgh. These are great centers of excellence with great opportunities. And we think, look, if we create the next Genentech, the next Intel, the next Qualcomm, the next NVIDIA, there's huge economic output that comes with that, not to mention all the great application companies that will be built upon this new infrastructure. But here's our challenge, right? China already has established a whole of nation approach to move out on these critical technologies, right? They've started investing in 2016. They have clear timelines and schedules. They want to lead the world in AI by 2030, advanced manufacturing by 2035. They want to start setting the world standards. We need to, meet that competition, maintain our leadership, and make sure that these technologies don't get used in authoritarian ways.
Yeah, Gilman, we got reports this week about the U.S. potentially asking Dutch-based ASML, which provides the equipment to make these chips, potentially to not provide to China. And we're not talking about the cutting-edge equipment, but maybe one behind that. And I'm curious, when you're talking about the competition with China, can the U.S. simply out-innovate China with the proper funds and structure in place, or does it have to come at the expense of China, taking away tools? I mean, how do you look at that competition?
Well, clearly there are certain tools that can be used that are used for national defense and national security issues. And I think, the issues around ASML and some of the other chip manufacturing relates to that. It's ironic, though, that, ASML's core technology, EUV, was invented in the U.S. and our American tech companies took a pass on it because they did not want to invest the capital infrastructure to convert to EUV, and it went to Europe. And now we're spending all of our energy trying to pull it back. I think as important as the protect side of the government is to make sure technologies don't go into the wrong hands, we need to have the production side. We need to make sure that the next go round, right? These technologies, which mostly is created in the U.S., right, builds great American companies that lead into the next economic leadership, that also supports our military and our defense posture as well.
We have to leave it there, but appreciate you stopping by here. America's Frontier Fund co-founder and CEO Gilman Louie, thanks for joining us.
All right, jean sales are riding a good deal of momentum into the crucial back-to-school selling season, at least from a Levi's perspective. Levi's is out with a better than expected quarter despite the broader consumer spending slowdown. Joining us now is Levi's CFO Harmeet Singh. Harmeet, always good to snag some time with you, especially ahead of the weekend. So, okay, sales were up, margins were up, reaffirmed guidance, raised the dividend. I get it. But you did mention one thing on the earnings call that I have not heard from Levi's in a while, some weakness in the signature side of the business. Those sales down mid-single digits. I guess that's the business you play in at Walmart and to a lesser extent at Target. What's going on there? Is that the first sign of consumer spending pressure?
Well, good morning, Brian and Brad. Thanks for having me. As you said, we reported a great second quarter and reaffirmed our full year guidance, firing on most cylinders. The demand signal that we saw, despite all the uncertainty, including inflation, was fairly strong and broad-based across geographies, across channels, and across our three pillar brands, Levi's, Dockers, Beyond Yoga, also being accretive. To the question you asked about the, our Signature and Denizen business, which is a small piece of our business, is about mid-single digit in terms of overall contribution to sales. And we saw that it was down in the mid-single category. Really, I think seeing the pressure on the value-conscious consumer. Most of our business is Red Tab and Dockers and Beyond Yoga now, and that was really strong. The signal was strong, and that caused us to reaffirm guidance despite headwinds. We're not out of the woods. There are headwinds around FX, China lockdowns, our suspension of business in Russia, etc. But despite all that, we resisted a strong quarter and reaffirmed guidance and are returning more capital to our shareholders than ever before.
So that weakness in that value business, Harmeet, that shouldn't be viewed as a leading indicator as we go into the back half of the year as pertains to other lines.
I think it's important to stay on top of it and be conscious of it. But overall, this, we see that the consumer is fairly strong. And this is my sixth recession. What I do see happen as things come back is consumers turn to brands they trust. If they have a fewer dollars, they'll rather spend it on brands that they trust than others. And the Levi's brand has been the strongest, I think, in decades or ever. Dockers is humming, and Beyond Yoga is a wonderful brand. I think I'll give you some stats, Brian. MasterCard came out with their Master Pulse report, and retail spending in June was up over 9%. Apparel was up 13%. If you look at the jean market in the U.S. over the last 12 months, at the end of quarter two, it was up 19%, higher than apparel. We've done some interviews with consumers, and more consumers are wearing jeans back to the office or as to get back on their social rendezvous, etc. Globally, our survey says that more folks are wearing denim back in the office. People just want to get, employees just want their employees to get back to the office. And so dressing in more comfortable and with great brands like ours, I think makes a big difference.
Come back to the office, wear your jeans, maybe wear your jorts. I know Brian's not a jorts fan. I'm a little more jorts curious, if you will. But Harmeet, I mean, as we think across, and one of my favorite statistics kind of that we've been able to glean insights from people like yourselves within this industry is the percentage of inventory that's actually being sold at full price. What does that look like for Levi's right now?
Yeah, I mean, it's pretty high. It's the highest it's been in a long time. And our gross margins reflect it. Our gross margins in quarter two were a record for quarter two. They were flat to last year, which was also a record. And as we talked about gross margins for the year, our guidance talks about a 20 to 40 basis points increase year over year. And so, we're able to sell a lot. We are chasing inventory. In quarter two, we said we missed about 2% of sales, largely in the U.S. And inventory, it takes a longer time to get across, into the U.S., just longer lead times in supply chain. So we built inventory, largely core inventory that you can sell through seasons. So think 501, the 511s, etc. And so, our view is that, demand is strong, and the consumer, is supporting the Levi's brand and Dockers and Beyond Yoga in a big way.
I mean, true story. A couple weeks I walked into a Nordstrom store to buy a pair of Levi's for the first time in a while. I just haven't bought jeans in a while. I tried on 10 pairs of pants. There was just so many styles. I couldn't get one that just fit my highly athletic looking body. I mean, how can you reinvent this experience to make it easier for folks like me? Yeah,
you should send me your details, and we'll make sure we have something for you. But to your point, it's something that we continue to work on. That's why we have the tailor shop in our stores, where you actually can go and they will help you get fitted on the right style. My true story on Nordstrom, about a year ago, I went to Nordstrom and I saw the Levi's pad along with the other competitors. So I asked the person on the floor, I said, how's it doing? He says, if I had my wish, the only product I would sell is Levi's. It's just get me more styles, get me more fits. And that's the brand that, consumers want. So I'm glad you went in and asked for Levi's. And our relationship with Nordstrom is growing, like with other premium retailers. And so, hope to get you fitted in the right style soon, Brian. But thanks for trying it on.
You had the leather jacket last time. You got the jean jacket this time. So we're going to be waiting on the edge of our seats for the next jacket that you wear when you're with us. Harmeet Singh, Levi Strauss Co. CFO. Thanks so much for the time today.
Thanks, Brad and Brian, and have a nice day.